Hey, what's up everyone, and welcome to the School of Personal Finance. In this video, I'm going to talk about investment costs, how you could figure them out for yourself, and also if you work with a financial advisor, how do they get paid? So there's many different ways that financial advisors could get paid, and I'm going to walk you through them just so you know what's going on. Let's get to it. If you're new to the channel, I talk all about personal finance, investing, and just trying to help you become better with your money. If you're interested in things like that, please consider subscribing. So let's jump into it. I want to start with the do-it-yourself investor and the costs that are associated with that. So if you like to buy individual stocks, sell individual stocks, trade stocks, build your own portfolio, the costs and the expenses could be zero. With different platforms now like Robinhood and M1 Finance, you could actually buy and sell stocks with zero transaction fee. And then there's no cost to owning stocks, to holding stocks. So you could literally have zero as your cost. Now, it's all on you. You're in charge of managing the portfolio and picking your own stocks. But for the do-it-yourselfer with technology, the costs have come down so tremendously where it's great. Even if you don't use Robinhood or M1, if you use a discount broker like Fidelity or Schwab, $5, $6 trades, I mean, it's very low cost. Great access, great technology, great research. The platforms are awesome. It's never been a better time to be a do-it-yourself stock picker. Now, if you'd rather not pick individual stocks and you'd instead like to buy ETFs and index funds, mutual funds, then the cost is going to go up a little bit. So now you have what's called an expense ratio for owning these funds. So let's say a Vanguard index fund, the expense ratio is 25 basis points. That's 1/4%. So if you have $10,000 invested in there, that means you're going to pay $25 throughout the year to own that fund. Now you want to be aware of what the expense ratio is on all the different funds that you own, because they could be much higher than that. So if you have a fund that has a 1% expense ratio, then that means that you're paying $100 a year on a $10,000 balance. So there's a big difference there. But overall, if you're a do-it-yourselfer and you're choosing low-cost index funds and low-cost ETFs, the transaction costs, the expenses, they're going to be very low for you. All right, so next let's discuss retirement accounts. So your 401k plan, your 403b plan. Now these could vary tremendously depending on who your employer is. So if you work for a very big employer, they might have a great 401k plan. They might have very low costs, have agreements with all these different companies, offer a wide variety of index funds, low cost funds, and the only cost to you might be the expense ratio on those funds. Typically with a 401k plan, you're not paying anything upfront to buy into these funds. There's no upfront sales charge. There's no annual fee inside of the 401k plan. The only real cost is going to be the expense ratio. And now 403b plans, they're a whole different animal. A lot of 403b plans have insurance annuity contracts in there, and those could be very high cost. So you want to know what you have inside of those plans. So a typical 403b could have an expense ratio where the funds are like 1%, and then you also have an insurance charge on top of that. They call it an M&E fee. So you could be paying 2.5% in a 403b account, and that could really, run up the expenses on you. So you want to be aware, you want to be able to put a dollar amount to how much it actually costs you to have your money in that fund. And the way to do that is to dig in, find the expense ratios for the funds that you're invested in, and see how much you're actually paying. If you're paying 1%, you have 200 grand in there, then you know it costs me $2,000 a year to have my money in this 401k plan. And that will help you make decisions even later on when you leave your job. Is it worth rolling out to an IRA? You just want to know the cost of what you're paying in these plans. And now these costs are not even associated with a financial advisor. This is just for the expense ratios of the actual funds that are offered inside of your plan. So now let's go to if you hire a financial advisor and how they actually get paid. So if you're working with a commission-based financial advisor, that means the way they get compensated is by selling you products that they earn a commission on. So if you go meet with them, you're not paying them for their time, right? They need to sell you something in order to be able to get paid. So maybe they sell you a mutual fund that they get paid a commission on, or they could sell you an insurance product that they get paid a commission on, or an annuity product that they would get paid a commission on. Say for example, you're retiring and you have $500,000 in your 401k. And they're recommending that you roll that over into an annuity product that's going to give you guaranteed income for life. It might sound like a great idea, but you have to understand that they might be getting paid 7% upfront when you purchase that product. So on $500,000, that means that they could potentially make $35,000 for selling you that product. That could definitely influence some people towards, recommending that variable annuity compared to if you put it into a managed account where they charge you 1% to manage the money, right? In that instance, then yes, they're making $5,000 a year to manage the account for you, but that's a lot different than getting a check for 35 grand up front for selling you the annuity. Another type of financial advisor that you could hire could be what's called a fee-based financial advisor. And that means that they could get paid either through commissions or through agreed upon fees. So they might charge you, for example, $1,000 to do a financial plan, and you pay them a fee to do that. But then with the financial plan, that might also have recommendations in it that they will sell you products that they also get a commission on. So if they do a financial plan and they say, listen, the financial plan says that you need life insurance, I could sell you this life insurance, then they could also get paid a commission. So it's kind of like a hybrid where they could get paid commissions or fees. You have to be careful in this situation because you don't want to pay a big upfront fee to have a financial plan done, and then the financial plan, conveniently spits out all these options that are going to be very high commission-based products where the advisor can make a lot more money on the back end. So you always want to know exactly how they get paid and how much they're getting paid for what they're recommending that you do. And then you could hire an advisor that is a fee-only advisor. And what that means is that they're not able to take commissions. So if they recommend an annuity product or an insurance product, they're not eligible for the commission. They cannot get paid commissions from it. The way that they get paid is through an agreed upon fee. So if they say to you, I'll be your financial advisor, I'll do a financial plan for you, and the cost is $3,000. That's the agreed upon fee, and there's no other compensation that they could receive from anywhere else. It's just the fee that the two of you agree upon. So that would be a fee-only financial advisor. And they could also get paid through assets under management. And what that means, if you have $500,000 in the 401k and they say to you, why don't you roll it over to an IRA and I'll manage it for you and I'll charge you 1%. So now having an assets under management model is probably the most common model right now. In my opinion though, it's not really the greatest, only because if you have $1 million with an advisor and you're paying 1% a year, that's $10,000 a year. If you have $200,000 with an advisor and you're paying 1%, that's $2,000 a year. Does it take 5 times the work for them compared to somebody that has $200,000 invested with them? And I would argue no. If you're basing it off of a percentage of assets, then that person with the bigger dollar amount, they're gonna pay significantly more in that situation. And then the last way that an advisor could get paid is just through a flat fee financial advisor. So that might be somebody who they just say, listen, it's $3,500 a year to work with me. I'll manage your assets. I'll do a financial plan for you. We'll, go towards all your goals, look at all your insurance. Everything is encompassed by that one flat fee, and that's just what it is to work with me. But there's no other commissions, there's no other way that I can make any money. There's no other conflict of interest. Whatever advice I'm giving to you, I'm not gonna get paid for implementing that advice or anything. It's just I'm your advisor and there's a flat fee charged for that. And some advisors will also charge an hourly fee. So if you just have a few questions, if you want somebody to look over your 401k plan or you want some advice about your life insurance, you could go meet with an hourly financial planner. Well, they'll just charge you for an hour of their time and they'll look at everything. And that's the only way that they could get paid is through that agreed upon fee that they're going to charge you, on an hourly basis. I truly believe that if everybody had access to a certified financial planner who was giving them unbiased advice and coaching them along the way, I think that everybody would do much better financially. If they had somebody that they could trust, that they could run things off of before they make major life decisions. It's going to help them budget, help them save for retirement the right way, help them do all these things at a very low cost, and they had access to it. I think that it would make everybody's lives better as they go through the different stages. That is a big reason why I'm here doing the School of Personal Finance. I'm going to find a way to create that for everybody. I think that's where the most value is. I think if you have somebody that you could email, that you could call, that knows your financial situation, and you could ask them, listen, I'm thinking about doing this. Do you think it's the right thing? I think that would help people tremendously. Most people don't hire a financial advisor because they feel like they're not sure if they could trust them. They don't want to be sold products. They feel like they don't have enough money for a financial advisor, or they just don't want to feel stupid. So most people just don't even do it and they just try to go alone. And it's just not the best way to do it. If you had somebody you could trust, that you could bounce ideas off of, that could coach you and guide you along the way, I think that would be a tremendous help. All right, hopefully that was helpful. I know it can be very confusing when dealing with a financial advisor, but the most important thing is just understanding how they get paid. I'm not saying that one is better than the other, but you just want to be very aware of what conflicts of interest there are. You want to make sure that that advisor is a fiduciary, that they have your best interests at heart. So in my opinion, having a flat fee financial fee only advisor is the best way to go, just because you know that there's no conflict. It's sort of like having a coach, having somebody on retainer where you know that they're giving you unbiased advice and you're not wondering if they're pushing something so that they're also making money on it. That's my thoughts on it. Hopefully you got something out of this video. Please make sure to hit that like button if you enjoyed it. Subscribe to my channel if you've not done so already, and I will see you again in the next episode. Thanks for watching.